Hi, everybody. This is Tim Melvin of the Tim Melvin Deep Value Report, coming to you with a weekly value view of the markets. It's a strong week for the stock markets. It's a combination of relaxed concerns about the future direction of the Federal Reserve, as well as some pretty decent earnings reports coming in, powered the markets to about a 2% gain on the week, while the All World URTH ETF that I like to track is up about 3%. All of the concerns about a China slowdown and an emerging market blow up seem to be fading into the past, and earnings growth is helping traders feel more comfortable being on the long side of the market. Now, when you dig into some of these earnings numbers, it looks pretty good on the top line. We have about 9% blended earnings growth so far. We're about halfway through earnings season. Financials have absolutely led the way. We're seeing some very strong earnings growth out of the banking and insurance sectors pretty much across the board. But when we dig into this, what we're finding is that we have a 9% earnings growth rate. We have a 0.9% revenue growth. We're still not seeing any top line growth in domestic stocks, those in the S&P 500. This is concerning to me because this tells me that most of the earnings growth that we're seeing is a result of financial engineering, buybacks, shifting assets around the balance sheet into the income statement, this type of thing, as well as, of course, what we all call cost cutting, and the folks on the other end of cost cutting call it being laid off. So still a lot of manipulation of the numbers going on out there. Things are better. They are not great. We are certainly not growing business at a 9% rate in this country, although if you just looked at that top line earnings number, you might think so. It's this focus on the quarter to quarter number, making Wall Street's numbers, using their cash to buy back stock instead of pay dividends or invest in growth initiatives that might create jobs going forward, I think is really acting as a serious drag on the U.S. economy right now and contributing to the very weak jobs market that we still see. Corporations need to spend their cash in other ways than just to meet or exceed the quarterly estimate of earnings from Wall Street. Hopefully, we'll see that sometime in 2014 as they just run out of way to financially engineer a higher stock price. But we'll see how that all plays out over the year. And good news for us as value investors, we're starting to see some movement in gold. Now, you don't really associate usually the precious metal stocks with value types like myself, because I don't buy or invest in gold. The only gold I've ever bought has been as jewelry for my beautiful wife. Don't own any silver, never really accumulated metals as an inflation hedge or anything like that. I'm not sure I buy into that story. However, over the last year, we started to see mining stocks. It really didn't matter what you dug out of the ground, gold, silver, copper, even coal or iron ore. These companies saw their stocks get absolutely slaughtered. They were trading at 40 and 50% of tangible book value. And you probably could have liquidated a couple of these companies for more than the stock price at the time. Now, as gold, financial uncertainty around the world's coming back in. We're seeing some signs of growth, and that is always good for gold. And of course, a weaker dollar gave it a boost. I don't really care why traders are buying gold and silver. I love the fact that it's up 8 days in a row, gold closing at 13.18 and silver back up at 21.42, because it's having a positive effect on the mining stocks that we do own. We saw some of our mining stocks up as much as 10% in the last week and 15% or so over the last month. Hopefully, gold just keeps marching right on up and the mining stocks become that much more valuable. They're still all trading just at 50 and 60% of their tangible book value. So these stocks have a long way to go. One of the biggest tips we got that it was time to put money into this sector, because again, I'm not an expert on gold or silver. When I saw the large private equity firms starting to tiptoe into the space and new private equity firms being founded by industry veterans to buy assets while they were very cheap, much like we saw the same thing in shipping stocks at the beginning of 2013. That was a solid indication that asset values were maybe not done falling. I've certainly never bought the bottom in anything in my life, but they were close to it, and there was money starting to flow into the sector that was going to prop up asset values. So the combination of cheap stocks, unpopular industry, and this slow but steady appearance of private equity firms was a good indication to us that mining stocks were getting close to a bottom, and we moved into them throughout 2013. Now it looks like it's going to start to pay off for us. We track private equity money very closely to see exactly where they're putting money to work, because it's a good way for us to find cheap assets, and then we can start breaking down the companies in the industry. In other news that I found pretty interesting, the growth reports out of the Eurozone showed about 2.3% economic growth during the last month of the year. That's not exactly runaway growth, but it's better than anybody expected, and it's much better than it has been over the last couple of years. And this is interesting to me because when I went through the Credit Suisse global returns report that came out during the course of last week, they suggested in the report that buying into those markets around the world that have done the worst, with the worst economic growth, that now look like they may start to recover over the last 5 to 10 years. It's a much better strategy than chasing the hot money and the exciting market stories. Now, with that in mind, the worst performing markets that look the cheapest on a valuation basis right now are in Europe. They're Italy, Spain, Ireland. All look like they could be poised for very high long-term returns. If you look at them on just about any measure, market cap to GDP, Shiller PE ratio, these nations are still extremely cheap. They bounced back over the last year. There's still a lot of bargain opportunities throughout the old world, the European continent. So we're going to be looking at that very closely and hoping we get a sell-off where we can actually add some money to our international value portfolios in those regions. Really especially attracted to the European old family holding companies, where they've put together a bunch of assets and they're publicly traded for liquidity and tax reasons. When these things get cheap, they become absolute, almost eternal money machines. So we're looking for those very closely, especially, as I said, in Italy, Spain, and even Ireland. Greece will come under consideration if they ever get things even remotely close to stabilized over there. So anyway, that's kind of our value view of the market this week. There's a lot of talk about the bull market continuing. I don't know if it will or won't. I'm not a market timer. I'm horrible at this stuff. What I do know is that the value line median appreciation potential index is still reading just 30. As we've talked about in the past, studies have repeatedly shown that when that index shows that the average stock in the index, or median, has the potential to appreciate by 100% or more over the next 3 to 5 years, it's a great time to buy stocks. When it's below 55, it's time to seriously consider selling stocks. It's at 30 now, so we're definitely closer to a selling point in the stock market than a buying point if we look at that index. The market cap to GDP here in the United States is still very high. The Tobin Q ratio is on the high side of normal. So when you look at some of this big picture stuff, stocks are certainly not a screaming buy based on asset value or earnings potential here in the United States. They could go well higher. Traders do what they want to do, and I try to ignore them. What I do know is there's a lack of cheap stocks, safe and cheap stocks at this point in time. The only place that we're really finding any serious value is in micro cap companies, little 20, 25, $30 million companies that nobody pays any attention to for the most part, except me. A lot of the small banks are still very cheap. That's a powerful theme that we've talked about, that the small bank stocks could very well be the trade of the decade. That's some seriously get-rich potential in that industry right now. And there's still some bargains, but again, they tend to be the smaller banks, 25, 30, 40, $50 million market cap banks. We're watching that industry very closely and continuing to accumulate names in the sector. And of course, there are still some mining stocks that are very, very cheap. And if we're going to have a global economic recovery, the stuff that comes out of the ground, copper, gold, iron ore, all of that is going to gain in value. And these could also be a tremendous 5 to 10 year opportunity for a value investor. So that's where we are. We have a very busy week coming up. The Fed minutes will come out, and we can all sit around and psychoanalyze what they all meant by every single word that's in the report. And traders will try to take away some type of tone that will justify, I'm sure, a bullish exposure to the market. They usually do. We also see earnings from some stalwarts like Coca-Cola and Walmart, and those reports actually give us a better look. Walmart of the domestic economy, and Coca-Cola, I think, of more of an international view of the economy from those earnings reports. So there'll be lots of stuff moving markets around. We'll be busy down here in Central Florida, kicking over rocks, looking for special situations and safe and cheap stocks that we can use to make some money and grow our net worth over the next decade. Anyway, that's the view from down here. It's a 3-day week, 3-day weekend, and a shortened trading week. So enjoy the rest of the weekend, guys, and I will talk to you next week.